Welcome to Smart Wealth.
This is your daily stock analysis and catalyst talk. Today, we are looking at Nebius Group, the AI infrastructure leader.
Okay, let's just dive right in. We're looking at a name that has, well, it's already delivered massive gains, but now it's standing on the edge of what looks like a new hypergrowth phase. Nebius is positioning itself for a, frankly, staggering target.
It's a huge number.
$7 to $9 billion in annual recurring revenue, ARR, by 2026. And look, this isn't just optimism. It seems to be anchored by over $20 billion in secured contracts.
With some very big names.
Absolutely. The stock has already tripled, so the big question for you is whether this momentum is sustainable or if, the execution risk just outweighs the reward.
Right.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And what's so fascinating here is that we're dealing with a company where the forward guidance sounds, almost unbelievable.
Really does.
Yet the contracts that support it are verifiably signed. So this isn't some future possibility, it's a current deployment challenge.
Absolutely. So let's start with the fundamentals, the pure numbers. The revenue trajectory is just explosive.
It shows massive acceleration.
Take Q3 revenue. It hit $146.1 million. Now, that number alone reflected incredible growth, 355% year over year.
Yeah, to see a company scale that quickly, it just means they are tapping into a serious market need.
And that pace is only increasing. The full year 2025 guidance is a really robust $500 to $550 million.
Right, and to get to the midpoint of that, Nebius needs to deliver something like $235 million in the fourth quarter.
Wait, I have to pause there. $235 million in Q4 compared to $146 million in Q3. They are basically projecting to nearly double their revenue sequentially in one quarter.
That's it.
That just screams urgent, immediate demand for their specific AI compute capacity.
It does, and that leads us right into the number the market is obsessing over.
Yeah.
That 2026 ARR target.
A big one.
They're guiding for annual recurring revenue between $7 and $9 billion. So when you compare that to the projected 2025 exit rate, you are looking at a 7 to 9 times increase in revenue.
In just 1 year.
In just 1 year.
7 to 9 times. That kind of scaling is, it's historically rare. But you said this isn't just speculative, so where does all this conviction come from?
The conviction comes from the client list. It's the secured pipeline. This rapid scaling is driven almost entirely by these massive multi-billion-dollar deals.
With who?
With two of the biggest names in tech, Meta and Microsoft. Those contracts together total over $20 billion. This isn't about winning new bids. It's about executing on signed deals.
Okay, so let's unpack the competitive moat here, because this is the critical insight for you, the listener.
Right.
Why are Meta and Microsoft, who have, basically limitless capital in their own data centers, outsourcing this to Nebius? Why not just build it themselves?
It all comes down to specialization. Nebius isn't just another standard cloud provider. They're what's called a neo cloud.
A neo cloud.
They specialize exclusively in advanced AI compute. This is a hyper-optimized infrastructure built for running the most demanding workloads today.
And what does that mean in practice? What's the tech edge?
Their whole platform is designed around cutting-edge NVIDIA tech. We're talking deployments of the NVIDIA Vera Rubin NVL72 and the new Blackwell Ultra Compute architectures.
So the top-of-the-line hardware.
The absolute gold standard if you're running next-gen AI models.
But hardware can be commoditized, right? So what's the actual structural moat that keeps clients like Meta locked in?
That moat is operational efficiency. The company has its own proprietary cooling systems and a highly optimized software stack.
Ah, okay.
And that setup lets them achieve 20% higher operational efficiency. We're talking power consumption, workload throughput compared to standard competitors.
20%. When you're talking about multi-billion-dollar compute budgets, that is a huge number.
It's massive. It directly translates to lower costs and faster model training.
So that 20% creates incredibly high switching costs. If you're Meta, leaving them means ripping out huge efficiency gains.
Exactly. It makes them sticky. It creates that durable advantage they need.
Now, we have to talk about the flip side of this, because it's the biggest risk factor. When company scales this fast, it burns through cash. What's the financial health look like?
You're right. This is where the risk is. Profit margins are pressured right now. They're reporting widening losses, negative free cash flow.
And that's because of massive capital expenditures, or CapEx.
Precisely. For our listeners, CapEx is just the money Nebius is spending now on GPUs and data centers so they can generate that $7 to $9 billion in revenue later.
They're spending aggressively to build out the capacity for those signed contracts.
They are, but the optimistic view is that they have the funding pipeline, they've got $1.4 billion in cash right now,
Okay.
which is meant to help fund a reaffirmed $2 billion CapEx plan. This gets them to 2.9 gigawatts of capacity by 2026.
So they're short about $600 million on that plan, which implies they'll need more funding, even if it's non-dilutive.
It's an aggressive timeline, for sure, but management is targeting operational leverage as those platforms scale.
What's the goal?
The goal is to hit break-even by the end of 2025 and then achieve strong 20 to 30% EBITDA margins midterm.
Okay, so the story is spend hard now to secure a massive immediate revenue stream and bank on that 20% efficiency mode.
That's the bet.
Which makes sense. But how is the market reacting? That brings us to sentiment and the technicals.
Well, the market has already reacted pretty strongly. The stock tripled over 2025. It's been trading near the $100 mark recently.
And if you zoom out, the long-term trend is undeniable. $100 invested 10 years ago would be what, almost $780 today?
Yeah, that's a 22.58% compounded annual growth rate. So this is a proven company leveraging a huge new opportunity.
And technically, the stock looks pretty resilient. It's trading above the key 50-day and 200-day moving averages.
Right, for technical traders, those averages are acting as a strong, rising floor supporting the trend.
But the word you absolutely must keep in mind here is volatility. This is not a quiet stock. The beta is massive, a whopping 4.0.
And to put that in context, a beta of 4.0 means if the market moves up 1%, Nebius is likely to move 4%.
It's like strapping a rocket engine to the stock price.
It is. It's great when the sector is flying, but it's terrifying on the way down. You need a strong stomach.
Yet analysts seem to be embracing that risk. The consensus is a moderate buy or full buy.
And the average price target is around $144.71, with some high-end estimates pushing up to $175.
And longer term.
Longer term. If execution is flawless through 2026, some forecasts are suggesting upside towards $500 a share by 2030.
That's the real price. Okay, let's talk flow. The quantitative sentiment is bullish.
Moderately bullish, yeah. The algorithms are registering the big contracts, acknowledging the upside.
And that brings us to the factor that makes the stock truly combustible.
The short interest.
The short interest. It's high, sitting at 15.47% of the float.
Which is about 33 million shares. And the key metric there is the days to cover, which is at 2.76 days.
So for our listeners, what does that number actually mean?
It tells you how many trading days it would take for all the short sellers to buy back their shares.
So because that number is pretty high.
It signals a massive supply shortage if a positive catalyst hits. In other words, you have the fuel for a potential short squeeze.
A coiled spring waiting for a good earnings report. Now, we did see some insider sales. That doesn't worry you.
You have to differentiate. These were routine sales, like a director selling 500 shares.
Okay.
They're characterized as liquidity events or sell to cover for taxes. It's not coordinated cluster selling, which would be a huge red flag.
That's a vital distinction. And on the other side, we're seeing institutions buying in.
Yeah, institutional ownership is rising, currently at 21.90%. Big funds are accumulating stakes. They are clearly betting on that 2026 target.
Okay, finally, what's the unconfirmed chatter? What are people speculating on?
Two things. First, there's always noise about potential acquisitions in this neocloud space.
Yeah.
Second, the chatter is that Nebius is hunting for 2 or 3 new hyperscaler clients. If they land even one more big name, it would dramatically reduce the customer concentration risk.
Which leads us perfectly into the core debate. Segment 3. The bull case versus the bear case.
Right. Huge upside, but huge challenges.
So let's start with the bull argument. Why is this an 8 or 9 out of 10 for conviction?
The bull case really rests on 3 pillars. First is the verifiable pipeline. You have $20 billion in signed contracts.
So the growth is visible, it's immediate.
Exactly. The second pillar is the moat. That specialized NVIDIA infrastructure and that 20% efficiency gain, that's a durable advantage.
And the third pillar?
It's the momentum and mechanics. Strong technicals, that explosive high beta, and the high short interest. If they hit their Q4 target, the upside could be explosive.
That's a very compelling case. But let's turn the light on the risks because they're profound. What's the #1 bear argument?
It's all about execution and capital intensity. The biggest challenge isn't winning deals, it's executing them.
Fulfilling that $20 billion in orders.
Yes. It requires an aggressive build-out, which burns cash and raises dilution risk. You have to trust that management can handle a $2 billion CapEx plan in this supply chain environment.
The scale of that build-out is just immense. Risk #2, then?
That would be customer concentration. A heavy reliance on Meta and Microsoft is a clear vulnerability.
So if one of them pulls back?
If either client slows down their AI investment or changes strategy, it would crush Nebius's revenue trajectory instantly.
It's a huge bet on two customers staying fully committed. And the final key risk.
Just plain volatility. That high beta cuts both ways. While it amplifies gains, it also amplifies losses. You have to be ready for big price swings.
So given that whole debate, what is the single most important event we're watching for?
The key inflection point is the Q4 2025 earnings report. That's expected in early February 2026, and it's critical for two reasons.
Okay, what's the first one?
They absolutely must hit or exceed that $500 to $550 million full-year guidance. A miss would shatter confidence.
And the second, more crucial reason.
They have to critically reaffirm that $7 to $9 billion ARR target for 2026.
That's the signal.
That reaffirmation tells the market, we're on track, the CapEx is working, the pipeline is real. That confirms the whole thesis.
So this is a high-conviction, high-risk play, definitely positioned as an AI infrastructure high flyer. The thesis really does hinge on holding through that 2026 inflection point.
The sheer size of the guaranteed work ahead is what separates this story from just being pure speculation.
So what does this all mean for you? You've seen the risks.
Yeah.
Capital execution, customer concentration. The core question for any investor here is whether that efficiency moat, that 20% operational edge, is strong enough.
Is it robust enough to insulate them from the giant hyperscalers?
Can they maintain that edge long enough to fully execute that massive $20 billion pipeline before Meta or Microsoft just decide to build it themselves? That efficiency advantage is what they are betting the entire company on.
And it's just essential to stay informed. That Q4 earnings report in February will either confirm or deny whether their operational success can match these aggressive financial targets.
We'll keep tracking the fundamentals and the flow right here. Until next time, stay smart.